Did Congress just give seniors a new $6,000 tax credit? Not exactly. Actually, what they did was they created a new deduction or personal exemption, and this exemption phases out at higher incomes. So let's break it down. I'm Michael Baker, and for nearly 2 decades, I've been helping couples prepare and plan for retirement with clarity and confidence. Today, we're going to talk about this new $6,000 deduction that applies for seniors, what it is, how it works, and how you might be able to apply it in a proactive tax strategy for retirement. Let's dive in. So what is this new deduction? First of all, anytime there's new tax legislation, one of the scariest parts of legislation for me as an advisor is starting to read all of the misinformation that gets out online. We live in a world where more people care about being first to report information than they care about actually being accurate. So what we want for people who watch this show and watch this channel, we want you to understand what the facts are. And then if there are questions you need to be asking or certain nuances, we want to dive into those. So what is this new deduction? Well, in the big beautiful bill, they created a new deduction for people that are over age 65. So the first thing is if you are not 65 years or older, this deduction does not apply to you. If you're over 65, each person in the household, so if you are single file, you get one. If you're married and both spouses are over 65, there are potential for 2 new deductions. That amount is going to be $6,000. So again, if you're single and you're over 65, you have the potential for a new $6,000 deduction on your tax return. But if you're married and you're underneath the income phase out thresholds, you could have up to $12,000 in additional deductions or exemptions on your taxes. First thing you need to understand is that this is not a tax credit. A tax credit reduces your tax liability dollar for dollar. What this is this is actually a deduction. So this reduces your taxable income. One of the neat things about this additional deduction is that it's actually an additional deduction. If you file a standard deduction or if you itemize, but you're underneath the phase outs, you can still claim this on your taxes. So it has the ability to create a nice little tax impact for those who qualify. Unfortunately, this new deduction is only temporary. So from tax years of 2025, so this year, 2025 through 2028, those are the only years that this new deduction is going to be available. Now, of course, that does not mean that things could not change in the future. With new tax legislation, they could attempt to make it permanent. But for now, we have this small window of opportunity for people to take advantage. Perhaps the most important thing for you to understand about this new deduction is that it is subject to an income phase out. So your income, if you are single and your modified adjusted gross income is over $75,000, well, you begin to see this deduction phase out. If you're married, that threshold begins at $150,000. But here's the neat thing that you should take away from this video is that even though there are income phase outs, the phase out is very, very minimal. We've already started running tax projections for some people with our tax planning software. And even with Roth conversions and some other things happening, we are seeing some phase outs, but it is not phasing out very quickly. That's because there's an additional $100,000 range for that deduction to phase out. So if you're single, the phase out begins at $75K, but it doesn't fully phase out to $175K. If you're married filing joint, it starts at $150, but it doesn't fully phase out until $250. So that is a huge window for you to still have some benefit of using this deduction. Okay, let's take a quick recap. We've talked about what this new $6,000 is. It is a deduction. It is not a tax credit. It applies for people who are 65 years and older, and if they're within the income phase out thresholds. Most importantly, This is temporary, so don't let this become your new normal. We have several years from 2025 until 2028 where this deduction is going to apply. Now, that doesn't mean that we can't see this thing extended or possibly made permanent in the future. However, we have to deal with the laws that are on the books, and right now, this is a temporary deduction that's available. How might you want to use this for a planning standpoint? Now, however, there are two different types of taxpayers. There are taxpayers who always want to pay the lowest possible amount, and then there are taxpayers who want to pay the lowest lifetime amount. They're two very different thought processes. So which one are you? Let me know in the comments. I want to know, do you want to always pay the lowest possible bill every year, or are you more interested in paying the lowest possible lifetime bill? Because if you're interested in paying the lowest possible lifetime bill, that may mean that you need to think strategically about your taxes, not necessarily tactically. Okay, so many people are coached. If you are one of those taxpayers who wants to pay the lowest amount, then this new deduction, if it applies to you, is actually going to provide you some tax relief. What you should see is your taxable income being lowered by this as long as you qualify, and you will get a little bit of tax relief. However, it's temporary. In my opinion, because it's temporary, I would not recommend anybody to just totally alter their lifestyle or how they do taxes. Just understand you may see a couple of years where you get a little bit of a refund or you pay a little bit less than you've been paying in years prior. However, if you're one of those taxpayers that likes to think strategically and wants to think about how they can use this new tax relief to your advantage, there are several planning opportunities that I think you should consider. First, Roth conversions. If you have a large amount of assets tucked away in 403Bs, 401Ks, or IRAs, these are qualified retirement funds, meaning you're going to have to pay tax when you begin to use these dollars. Any chance we get to use these dollars at low marginal or low effective rates, we want to be looking at the highest and best use of these funds. Well, we just had this opportunity given to us where we have a temporary window where there is a new deduction that could be used. Now, granted, deductions don't necessarily have the same tax impact as credits, but it's still some potential tax relief. If you're married, you have the potential for an additional $12,000 in deductions, in addition to a standard deduction or in addition to itemizing. So you really want to look at this and see how you can leverage this new tax benefit for your benefit. The second thing is just structuring IRA withdrawals or withdrawals in the correct order to maximize tax efficiency. A lot of people have multiple different types of accounts. They may have Roth accounts. They may have brokerage accounts with stocks and bonds. They may have CDs. They may have, other qualified retirement plans. One of the things when you get into retirement is you want to not only structure your withdrawals for tax efficiency, but you want to make sure that you're structuring them in a way that maximizes the longevity of funds. Anytime we have an opportunity to leverage the current tax laws for your benefit that gives us tax relief or allows for tax efficiency, we want to go back and evaluate our withdrawal strategy and make sure that we're not leaving money on the table, or worse, we're not paying Uncle Sam a penny more than we're required to pay. The last thing I'm going to talk to you about is look at capital gains or how you can use these new deductions to help minimize rebalancing portfolios, tax loss harvesting, or capital gains harvesting, because even though there are income phase outs, in many cases, if you look at where you fall in your tax brackets and you look at how you may be taxed on capital gains, there could be some opportunities for you to rebalance your portfolios or to make smart adjustments where you can now use this additional deduction to help minimize or potentially even help eliminate the tax bill. So those are my 3 ideas for you. If you're thinking about how might I apply this $6,000 new deduction for my own benefit, the first thing, look at Roth conversions. I love Roth. I think it's a phenomenal tool. Most people don't leverage it enough. Secondly, reevaluate your withdrawal strategy. Is there a way for you to optimize it or tweak it so that you're taking full advantage of this new, even though it's temporary, of this new deduction or personal exemption? And then number three, make sure if you have taxable or brokerage accounts that you're looking at tax loss harvesting or capital gains harvesting. We have new deductions available to you, so you need to mind those income phase outs. But this could be an opportunity for you to rebalance or restructure your portfolio and take advantage of this tax relief. Would this deduction actually meaningfully change your tax bill, or is it one of those things that's just nice to have for a couple of years? Let me know in the comments. And hey, if you want more clarity on how this deduction could potentially work for you or be applied to your plan, click on the link below, schedule your retirement vision call with our team today. Remember, tax planning isn't about making sure you pay the lowest bill this year. Tax planning or strategic tax planning is about making sure you pay the lowest bill over the course of your lifetime. If you agree with that, give this video a like.